After the market bounced off of good job numbers, well, things have kind of taken a turn for the worse, and we're right back where we were before the job numbers. Riz and I are going to talk about what to expect this week in the market. Good evening, my fellow Riz Elite members and all of our subscribers here on YouTube. Welcome to this week's Elite webinar. Now, if you want the most up-to-date, unbiased, and information that you're not going to hear anywhere else about the stock market, then make sure you do me a favor and get down there and you hit that like and subscribe button. Click the bell icon to get notified. We upload a new webinar here on the channel, but we have a lot to talk about because there has been a lot going on in the market and around the world, to say the least, and we need to touch on it. And I brought the man himself, Riz. Riz, how you doing tonight?
Good, Chris. Thanks for having me on.
It is always a blessing and an honor to have you here. And yeah, we missed you last week, but honestly, there wasn't a whole lot to talk about because we had this big rebound after the jobs release. And, the market basically kind of just consolidated for a couple of days, kind of bouncing up and down. Of course, there was a lot of intraday movement, but man, from Wednesday on, we just had nothing but red days, and we are right back where we were before the jobs numbers were released. It's rather interesting, honestly, because it seems like there's a lot of support here around this 42.25 area. And we are sitting right on it. But as a note, we have pushed and closed below the 200 simple moving day average on the market. We are maintaining this downtrend, but Riz, what happened here? Why did the market just puke?
Honestly, it's anyone's guess. I feel like I'm not gonna be able to draw conclusions into it too much. We know that, look, we had Powell kind of give a little statement there that got
Yep.
stopped briefly due to some protesters. But anyways, he was back. He said what he's always said, which is at least he's consistent, which is that rates can and should likely stay higher for longer.
Yep.
It sometimes it just doesn't compute in a sense that we know this, the market knows this. Why does it have to be said and then for the market to react after? Like, again, we can't, the market is such a construct that we can't always one-to-one designate because of B happened, right? We
Gotcha.
just can't do that. As much as people want to do that, as people, it's easy to do that, but that's not right. Ultimately, there's a lot going on. Nothing happens in a vacuum. And we also had, along with Powell, other Fed members speak as well. I don't really care what they say. I know some people might be listening and read their transcripts or whatever. I couldn't care less. I would literally much rather go to sleep or really do anything else. So that goes to show you how much credence I put into their words. But other than that, honestly, I think this is regular price action. There's a theory, again, nothing is substantive, nothing is conclusive, but there's a theory that a lot of the selling that's happening is potentially retail driven. I don't fully buy that because to have these kinds of big moves, that can't just be retail, right? You have some institutions either closing or moving money around. It can be partially retail, but there's more than that. You don't have these kinds of big red candles followed by each other just because of retail. And I was quite a bit surprised. Like, I can tell you looking back, I was a bit surprised to see this kind of move. I did see a potential pullback. If you guys remember 2 weeks ago, I said, look, I do see some further downside. And I mentioned that not only on the webinar, but I mentioned that on social media, IG as well, in my stories. And I was right. I'm happy that I was right, but could I have said it's going to come back right down to 42.24 2 weeks ago? No, but I did see some potential downside, and that remains so. And you touched on this, Chris. Like, look, we've seen that 200-day moving average right there, just literally just touched, and a slight smidget below that 200-day moving average. I don't count that as a clean break just yet. I need more confirmation. But simply put, if we get a further dip below that, I'm not saying it's going to be a straight line down, but that can spell further trouble for the market. We've seen that Nvidia has been getting slaughtered, right? We've seen Tesla has been getting slaughtered. Guess what? Those two stocks have been one of the larger gains for the year, right? And when we see these seven stocks, which is Apple, Nvidia, Tesla, Microsoft, Google, these companies that have had a good run in 2023 year to date, the moment they start pulling back, it drags the market lower, right? Because everything else apart from these, there's the Magnificent Seven, as it's called. Everything else has been languishing for the most of the year, for the better part of the year. It's these seven stocks that have been really propping it up, juicing the market. And the moment we see them pull back, case in point, Tesla and Nvidia, that takes takes the wind out of the sails of the broader market. So I know I give a little bit of a long-winded answer, but it's important to provide that context, right? It's not just, okay, well, Powell spoke, so that's why, or like, one individual thing only. No, from a price action standpoint, from a macro standpoint, economic standpoint, not too much has changed from a macro standpoint. So it's really just price action and these companies just pulling back, dragging the index lower.
No, it's a good point. And if there's the Magnificent Seven, I want to know who the Hateful Eight are. We'll have to kind of figure that out later. But it's a good point, and I have to agree with you. I don't see retail investors being able to push the market down this much. And just to kind of clarify, if you're not familiar with the term, a retail investor is like you and me, basically. It's someone who has their own, brokerage and things like that. It's kind of like what you refer to, I guess, as your mom and pop investors, right? Or as they used to say, is kind of a dirty word, the Robin Hood investors. But when Riz is talking about institutions, we're talking about hedge funds. We're talking about people that have way more money that you and I can fathom, and that can actually push the market down like this with the positions that they take. And so, yeah, I have to agree with you. I really don't think that mom and pop investors can really move the market this much.
Yeah, hedge funds, you got mutual funds, you got endowment funds, you got sovereign wealth funds, you got large asset managers, all those, right? So that there's trillions of dollars behind those, right? And obviously there's a lot of money out there, but predominantly so from a money flow standpoint, it's mostly institutions, right? Yeah, we have retail, but if you total up all the individual dollars that retail has, individual investors, individual traders, just essentially means retail, whether you are with Robinhood, which is or you're at another brokerage is besides the point. We're all retail unless you're managing money or you have a family office or something. You're kind of semi-retail really, but still, simply put, that distinction between retail and institution is important. And hopefully that gives you a little bit of clarity on, what each means and what falls into which camp.
Definitely. I think that's some good distinction to make. Let's take a look here at the breakdown for the S&P 500, and we can kind of see what's taken a beating here. Like we talked about, the Magnificent Seven here in tech and communications getting absolutely ripped. Looks like we started here on Monday up about 38% on tech, and we dropped almost full 5% on the week. So really big rollover in tech. Same here, with communications. Of course, there is some overlap between those two, but consumer discretionary took a beating this week. Pretty much everything just rolled over for the most part. However, I will say consumer staples are holding pretty steady, but still well below the zero line at negative 9.43%. But yeah, it's kind of like what you're talking about, Riz. You have these big companies that have been propping up the market, and when they dump, it kind of brings the market down with it.
Yeah, absolutely. It's a given, right? There's no shadow of a doubt where you have these leading stocks, and they happen to be high flyers. When the I don't want to say the bubble, but like once they're exhausted, you see the major impact on the market, right? It's not something that's a foreign concept. It's not unimaginable. We've spoken about this before, that the market's really been led by these individual seven stocks that are really leading the markets higher because they're also worth I should say they're larger constituent of the index, right? Because the index, the S&P 500, is market cap weighted. And the larger the company, the the bigger basket share of the basket or share of the pie it has, right? So when Apple moves, if it moves 2%, you can bet that's going to have a larger impact than some smaller 400 largest US company, and that moves 2%. The Apple's going to have a lot more weighting in that. So not surprising at all. You can see everything pretty much curled lower, some more than others. Like you said, we have what's it called? Consumer discretionary with the biggest, like I would say the most aggressive slope downwards.
About
Although
8%.
yeah, although we do see tech and communications also slope lower, lower, but it's not as aggressive. But very interesting to see that pretty much everything kind of just dips lower.
Yeah, let's take a look here at the asset classes because we got energy kind of peaking up here a little bit, and that's mostly pushed here by oil. But honestly, oil not getting too crazy. I listen to other channels sometimes. I got to tell you, and they're like, oh, oil's spiking, gold is spiking. I'll admit that gold has gone a little bit parabolic here. We'll talk about that in a minute. But oil really has just been kind of holding here below the $90 per barrel area. We kind of pushed up here. Looks like to about 93.68 in the end of September, but for the most part in October we've been below 90 and been holding there pretty steadily for the most part. We kind of dipped lower here than the low 80s, but kind of perked back up here over the last couple of weeks. Looks like we closed on Friday at $88.08 per barrel for light crude. But gold has been going parabolic here over the last couple of weeks. Riz, what is going on here? I mean, we obviously had this sell-off and we're having a rebound, but we're getting pretty close to that $2,000 mark per ounce, which we haven't seen since earlier in the year.
Yeah, that's a significant and surprising move. I'll be the first to say I did not expect that. That's a massive move for gold. Right off the 1830 whatever area support that was. And I think it was a couple weeks ago when I was on and we were like, it's right at that support. And wow, look at that, right? Like that's a big move. As far as why, I mean, no one really knows, honestly, that no one really knows why. All we can say is that perhaps there is a bit hedging going on. We know how gold hasn't been the best of the hedges over the last few years, but still, it is still an asset class. It is, there is a utility behind it. There is some physical aspect and carrying and utility behind it, unlike other assets, which I just won't, which I won't get into. But yeah, no, it's significant in from a move standpoint from just the last 2 weeks. Of course, I didn't participate in this move in gold, or directly even any move in oil. So no direct commodities exposure for me this past couple weeks. Just it's been mostly just focused on. I've been focused on predominantly market price action. And as we know, that's been a bit interesting all month.
It really has. It's been very whipsawy. We start the day up and then we just sell off, or the other way, it happens. We dip lower and then it goes up higher before it turns around in the afternoon. So it's been very volatile lately. And we do have something here with the bond market that we have not seen in quite some time. Is actually the 30-year bond yields are now back above the 2-year bond yields, which we have not seen in quite some time. Obviously, we've had the inverted bond yield curves for over a year at this point for the most part. And looking at the dollar, looking very strong after this big push here at the middle of July. Had a very nice move up, consolidating for the most part here, just mostly trading sideways. But Riz, my goodness, bond yields really kind of making a big change here and back to more what we're used to, with the 30 years being higher than the twos.
Yeah, and nothing too much to glean from that. I mean, yes, you're right. Absolutely. The yield curves were inverted for quite some time, seems like almost forever.
Yeah.
So kind of getting back up there, but I wouldn't say, okay, well, yield curve inversion's over, it's done, okay, no, it's not yet, clearly. They're just converging more so, and it's what's interesting is all of them, as we can see, have been trending up to and past almost for the 5% yield. As you can see, it's interesting the higher it's going. We've seen gold go up as well. Obviously, oil is hasn't come up to that $100 area, but still kind of languishing around the 90 area. So it's interesting to see these things occur. Even the US dollar compared to other currencies, the DXY, the index, US dollar index consolidating a bit, but still holding up. So you can see how different asset classes are doing in relation to the equities market, the stock market. And whereas the stock market is in a clear downtrend from July highs, you have, right there, right? So from the July highs, or sorry, exactly, end of July high. So from that is a clear downtrend, right? Whether it's sustained or not is besides the point. You can see as the equities market trend lower, you have bond yields going up. You have US dollar has been going up, obviously, since July. If you look at that, we have gold, obviously, significant rally the past couple of weeks. So it's important to, I would say, directly compare. This gives you an idea where the money is going, institutional predominantly. Yeah, it's some retail as well, but it goes to show you where this money is flowing. And I wouldn't be surprised some of it is exiting equity markets.
Yeah, I know it's a very good point that kind of having a better understanding of the whole picture of what's going on is so important. It's not just, oh, is this stock going up or is it going down? There is no one indicator that tells you everything. It's not the bond yields, it's not the strength of the dollar, gold, oil, the S&P 500 itself. It's everything all together, and understanding that is so critical to having a broader understanding of the markets and how it behaves. So that's what you're getting here. So, if you've made it this far in the video, please make sure you at least give us a like and subscribe, because we want to reach more people. And to do that, we need your help. So please do that for me. I would really appreciate it. For all of our elite members here, let's go ahead and start typing in our questions for Riz, because, he's here. He wants to answer your questions. But first, let's take a look at the important dates for the market this week. So obviously it looks like Powell's going to talk again here on Wednesday. That ought to be interesting as always. We've got a couple of things. We've got GDP growth rate quarter on quarter. We've talked about what that is before with all of the ways that they handle that. And then we've got some good stuff here coming in on Friday. We got the core PCE price index month on month, and then personal income and spending is always interesting to see. But it looks like for the most part, they're not forecasting anything too drastic as far as, previous months are concerned, about 0.1% here or there. I will say that it looks like they're expecting a pretty big jump in GDP growth quarter on quarter. So that'll be interesting to see how that, kind of comes out. But Riz, obviously Wednesday is going to be, in my opinion, the big day. Are you planning anything for that one?
No, there's really no point. It's just too much of a toss-up at this point, especially where markets are. I'm not too thrilled or certain. I need some confirmation, like I said earlier, because we're right at that 200-day moving average. Powell can obviously sway markets, as we know, but there's nothing I can pinpoint and say, okay, I'd like to hedge this specifically or hedge that, or take a position around this. Just nothing specific to that. As far as GDP numbers, yes, that's quite the growth rate. It goes to show you how even with what is it like? What are we at? Like, I think a 5% benchmark rate. What are we at, Chris? I don't even remember. Like, mine's blank.
I think that's what it is. I don't know off the top of my head. We'll have to look that up.
Yeah, like let's just say 4.5 to 5% benchmark rates. Even with that being around, I think 2008 levels, 2007 levels, you can still see the economy seems to be chugging along, seems to be quite resilient and strong. And that proves to you how much money, I would say, was accumulated. Part of it was given out, but most of it was accumulated during 2020 and 2021's so-called pandemic type of years, right? And that, I think, really that money is continuing to be dwindled down. We've seen people's savings rates continue to decline. We've seen obviously debts go up in terms of credit card carrying balances, credit card charges. We've seen loss provisions for banks go up. So the banks released earnings last week, not some of them at the start of the week, but some of them the week prior. And what we can see is a lot of them are carrying unrealized losses on bonds, but which they claim to be which they claim to be carrying through maturity. But also, if you look a little bit deeper, you see they have some drawdowns or some charges that they booked for bad loans and credit defaults. So nothing's crazy, but you do see some of these cracks and these little question marks forming, right? And with the GDP number coming in at 4% even, like, phew, man, that's substantial. Like,
Mhm.
I let's see, it's the advanced number. They usually revise it. But again, that's the quarter-over-quarter growth rate. So that tells you it's still continuing. It's not, from what I understand, how they've listed it, it's not the annualized number, but it's just essentially the growth in the GDP itself, which is still, sizable, but let's really see what it comes into.
Yeah, it's definitely impressive, especially since, they're trying to push interest rates up to cool the economy off. It seems like they're having the opposite effects, at least right now. I don't have the earnings whisper in front of me, but I know we're getting into earnings season. Are there any tickers that you're keeping an eye on this week, Riz?
Yeah, so let me pull that up on my end. You won't be able to see it on the chart. Okay, whoops. One sec. Bear with me here. Okay, so it's gonna be a big week. We got a big earnings week here. What do we have? Let's see. We got we got Visa, 3M. Those are, some not too big, but the big heavy hitters, Microsoft, okay, Apple, aka Google, sorry, Alphabet, aka Google. We got Meta, right? Facebook. Those are big ones. We have what else? We have UPS, okay, Amazon, another big one. So it's gonna be a big week. We already had Tesla, we already had Netflix last week. So you can bet the bigger companies, like I mentioned, the big seven, Microsoft is part of that, Alphabet, Google is part of that. Meta is up there in that as well, and Amazon, right there. So that's going to definitely impact the market more than anything else. Even I think Powell speaking, whatever he says, or if the markets have a reaction, I think more than anything, how these companies do, how they release, how their numbers are, how their guidance is, and as a result, how the markets reacts to that, it's going to be the bigger potential for a move.
Absolutely. All right. So we got a couple questions come in, and thank you guys for putting those in. So Abhishek says, if the S&P 500 can defend the 200 simple moving average, how do we feel about taking Amazon for a swing up to high 120s, low 130s? I mean, obviously with earnings coming up, that's a big question mark. Looks like we've got it Thursday after the close as far as that's concerned. But man, I mean, Amazon seems to be kind of taking a bit of a hit here since about mid-September, definitely coming down a little bit. Obviously, there's quite a lot of room to the downside and the upside, but yeah, I mean, this is a little tricky on this one. Riz, what do you feel about Amazon?
Yeah, we got that. Look at that consolidation support, not consolidation. Look at that support, that triple bottom. You look at that 124, 125 area, strong support. Obviously below the 50-day moving average, obviously below some of the previous September highs. But like you said, it could continue to run down to 116, 200-day moving average. But of course, we do know earnings, big catalyst there, right? Big coin toss. Usually around that stuff, technicals kind of go out the window,
Oh, yeah.
right? So if you want to play earnings, yes, I think you're right. You can take a swing trade on it, but man, I feel like with earnings, you're either in for a fun trade or a painful one.
Yeah. No, I feel you on that one. Earnings is always a coin toss. So I mean, yeah, let's hypothetically play out something here. So if we see it run down to 124 and it defends there pretty easy and starts to curl back up, I mean, if you want to take something really quick and try and get in and out before Thursday, that's a potential way to do it. Yeah, before earnings, but man, you've only got a couple days for that trade to, basically hash out, and there are a lot of other forces pushing against you on that. So I mean, time is not on your side if you want to try and get in on this before earnings. It feels a little risky to me.
Yeah, and from a fundamental standpoint, which we haven't touched on, Amazon's overvalued. It used to be the opposite, right?
Yep.
At the start of the year and even 2022. But you'll notice I haven't traded Amazon too much, especially not even on the long side or short side, simply because apart from technicals, there isn't much margin of safety. If just looking at basic fundamental ratios, there's just great company. It's not like it's going out of business or it's not making money. It's making money. It's just the valuation is quite frothy. So when we have anytime I'm not certain about a trade or a setup, I also factor in fundamentals. And, even let's just take earnings out of the account. Looking at the fundamentals, how would I feel about, this as a carry trade? I wouldn't be too confident knowing where the fundamentals are. So if we see a break below 124, I would maybe lean bearish. Again, not factoring in earnings, but that's if.
Yeah, I just feel like you don't have enough time for the trade to work. It's one of those things where you could absolutely be right, but your time horizon is so short with it being Thursday after close that you may just not have enough time for it to work out. All right. Robert says, I'm sort of lost on the news around Echan. I'm not familiar with that one. Seems mixed reviews on the future of the company. Curious on your thoughts, Riz.
Carl Icahn, IEP.
Got it.
So, man, I remember trading this, right? It was fun. So yeah, Robert, that's a good question. We have a company that absolutely got decimated off that short report by Hindenburg back in the summer. Massive, massive volatility, like just wow. Like just look at that chart, like try and make sense of it. There is no sense, right? It's just literally all catalyst and news. So it goes to show you right here, Exhibit A, that technicals are just one part of the equation, right? Like, yeah, they're price action, they can tell you quite a bit, but ultimately they're moving, in this case, based on external catalyst. And that is, Hindenburg research coming out, Carl Icahn stating, making a statement, then IEP, his company, cutting dividend, right? All these things are happening. And as a result, you're seeing that play out in the price. There's a reason I don't hold this stock. We sold it. We got out quite some time ago, Robert. So I don't know your stance or your position on it. You haven't mentioned, but in terms of continuity of the company, in terms of, if it's going to survive or I'm sure it's going to survive. Carl Icahn, as great as he is, he made a mistake of being over levered, and because of that, he left himself open to someone taking a closer look, and that happened to be Hindenburg, and then making that apparent and making the risks apparent, and then that spooked everyone, right? Like you could see that from $50 to $52 to just absolute decimation. Like just looking at it, it's painful, right? Imagine what Carl's going through. He's thinking he's like 85 years old. So he's an absolute killer. But yeah, Carl, I mean, not that he's listening to this, but he made some mistakes, a bit too much leverage, right? Because Carl Icahn and IEP, this company, used to provide a significant dividend yield. It wasn't sustainable. I knew it wasn't sustainable, but he had been keeping it going for quite some time. Of course, once there was blood in the street, then everyone decided to dump, and he had no choice but to cut the dividend. So the dividend is still there; it's just significantly cut, and the market's pricing in a potential further cut in dividends, right? So that's something to be aware of when you have these high yield companies. That's why I tell people don't chase yield. Yield is a number you can pay attention to, but it should not be the sole or main determinator of whether you buy, hold, or sell a company. Only it matters, but in this case, I think the company is going to continue. Carl's going to bounce back. Am I holding this? Absolutely not. Is there a potential trader set up yet? No, not yet. So, again, Robert, not sure if you hold, but hoping you don't.
Yeah, I wouldn't touch this one. It sounds like Carl got a little bit too big for his britches, as we would say here in Indiana. Robert says he's in a small position, but nothing crazy. Just needed some wisdom, aka wisdom, fallout, and appreciate it. Absolutely, I'm glad that we could give that to you, Robert. Really great questions tonight. Thank you, everybody,
Yeah.
for those.
Yeah.
Really appreciate that. Very deep and well written questions. So excellent work.
Love it. I
Yeah,
love
for
that.
sure. For sure. Me
Definitely.
too.
I mean, I love it. These amazing questions obviously turn out. It's important to have a good turnout and the great questions and participation. I mean, we do this for you guys. Obviously, Chris as well. But as you probably noticed, for those of you that have been on these or paying attention to the recordings, I've made it a point to be on here significant, like exponentially more the last or all of this year.
Oh yeah.
In fact, I have some people over, I have family over right now, and I said, look, I got to do this, so you guys do your thing. So yeah, I appreciate the support. I appreciate everyone coming on. It'll be good to have this continued momentum. But yeah, great questions, and I thank everyone for coming on.
Definitely. Well, we won't keep you from your family. Thank you, everybody, for coming out. Really appreciate it. Of course, special thanks to Riz for coming and being on. It's always a pleasure to have you. And we are going to be keeping an eye on the things this week. Obviously, there's a lot going on around the world. So, just kind of in closing, enjoy your time. If it's the weather is nice where you are, go out and enjoy it, because soon enough, it isn't going to be so nice anymore.
Yeah,
So
depending
go
on where
have
they are.
some. Yeah,
Yeah, I
for sure.
mean, maybe I mean, if they can enjoy it year round, they're probably doing something right.
Yeah, right. They're not having to watch one of these webinars, I'll tell you that much. But for the rest of us who do, go and enjoy yourself. Have a great rest of your weekend. Just relax, take it easy, because don't worry, the market will still be here. And as always, we'll see you in the market on Monday.